And looking at these trade numbers, how much are they reflecting this surplus that we have, the high price of commodities that we witnessed through 2021?
Well, I think in general, the surplus we have in China is not necessarily a story about commodities. It's a story basically that the demand was very robust in the developed world. I think that's the main story that we have here. And I think that element is likely to persist. Global growth will be above trend in the first three quarters of this year. And I think historically that is a supportive factor. Plus, we do still have a fair bit of structural factors that point to higher commodity prices, and the supply side is challenged. And I think that also speaks for higher prices. That's why the guidance from our perspective, we're going to get probably returns around 10% on a broad index level when it comes to commodities.
Yeah, so give me a sense of what's going to drive that in particular, Dominic.
So if you look at the commodity complex, I mean, first of all, the oil market is in deficit. You see inventories drawing quite radically. On top of it, OPEC Plus is pretty much in control when it comes to the output trajectory that we expect this year, and so that means pricing power is here. So why not looking at oil price heading towards $90? On top of it, the futures curve's downward slope. You're going to get a material roll gains of around probably 10%. It's quite a lot if you think about a world that is starved by yield. And so that is a return driver. The other effect is we look at all the base metals. They are, in our perspective, expected to basically be undersupplied, and looking at copper heading towards $11,500 a ton. So if you add that cyclical component, then you get a quite strong backdrop. Fair enough, we're still bearish on gold. We think the dollar should be strong, gold should be weak, but that's not going to move the needle on a broad index level. And when it comes to agriculture, it's probably more of a sideways to upward trajectory. So a good diversifier actually for investor in the portfolio.
So looking upbeat for oil, how about nickel? I mean, at the highest in a decade, expectations are demand will continue, especially on the back of, Indonesia thinking of putting a tax on its nickel exports.
Well, nickel is interesting. Yes, definitely you have the story about the structural demand driven by EV, and I wouldn't be surprised if we, trade at $24,000 a ton, but there's also supply side, which is improving quite a fair bit. So that should shine throughout 2022. So I wouldn't be surprised that some of the gains that we see here is going to give up, and we might end the year at 20,000. So you need to be a little bit nuanced as well. Is nickel going to be a game changer on a broad index if our investors when he engages? No, it's not, but just be mindful. Not all metals are equal at this point in time. Where supply can react, you need to have a little bit of a short-term focus when it comes to the return outlook.
Dominic, when we talk about commodities, you have to take a look at the dollar. Lots of people now saying that the dollar has peaked or will be peaking soon. What will that mean for demand? What assumptions are you making?
Well, we're not in the camp that the dollar should basically peak. I know there's a lot of analysis out that says basically when the Fed starts to hike, then that's historically the turning point for the dollar. I like to caution here a little bit. If you, for example, look at the analysis versus Europe, first of all, central banks dynamics is going to be different. I think we need to take that into consideration. That's number one. Fed is going to hike. The ECB is going to stay on hold, still going to do QE. Maybe next year that the ECB is going to move. There's different inflation, particularly on the wage side, different trajectories, and I think that also means a different reaction from the central bank. So I think that still calls for a lower euro dollar. That's number one. Number two is you look at portfolio flows, for example, in Europe, they're still negative, and I think that's something that is not going to change. I don't see any, focus that people say, the bond market in Europe is attractive, or there's so much rotation out of tech into value that you need to favor European basically equity. I don't think that's going to happen. So on top of it, and I think that's an important thing, while global growth is above trend, just don't be fooled. Towards the end of the year, global growth is stepping down, and historically a decelerating global growth picture is dollar supportive. So I would still look for dollar strength. Maybe there's an end point, but still looking at euro dollar heading to 110, and people should hedge their currency exposure.